Welcome back. This is your host, Christy Slaughter, on SuperTalk Saturday mornings, WFHG 92.9. Thanks for tuning in. Today, we are here in Bristol, Virginia, with our special guest, Bill Potter. He is a financial advisor, and we're also joined with Tim Wood. He is a broker and the owner of the planadvisor.com. Thank you all so much for being with us.
Thanks, Christy. Appreciate it. Glad to be here.
Okay, let's go ahead and talk to you, Tim, for just a few minutes. What is the Plan Advisor all about?
Well, here's kind of how I like to describe it. We put a team together, and essentially we're passionate about helping our neighbors make a plan for retirement or the unexpected, whatever may happen, and to make sure that plan will be the best available for them, both income and tax-wise, once the time comes. We like to be the safe money specialist, basically. There's so many programs out there, and sometimes our clients are already in the best one, and we tell them that. But many times there's other options that may be a little bit better, and we're just there to essentially give them the advice and show them what's available and make sure that they're, in the right thing. That's kind of what we're about.
Bill, what about people's retirement during this economy and this time that we're living in right now? I know a lot of people have questions. We are opening up the phone line. It's 1-800-469-0098 if you'd like to join the conversation, or if you have a question for Bill or Tim. But what about retirement? I know there's a lot of uncertainties. Can you give us some information about that, Bill?
Well, right now, a lot of people probably have had to postpone some things, just simply because they probably can't physically get it done because HR departments are shut down or whatever, and they may not be actually at work. So maybe they postpone their plans right now. And one thing that we would probably tell them to do is pull back money out of equity products through the stock market right now and kind of get more safe haven because of the uncertainty, as you spoke of, in the market. And all the experts are saying that there's probably going to be more of a downturn within stocks over the next several months. So you don't want to be trying to make up losses when you're 60, 55, 60, 65, 70 years old, leaving your job and going to have to rely on your income coming from your retirement assets that you've accumulated over your lifetime.
Bill, let's focus just for a few minutes on Social Security. If people aren't familiar with how Social Security works, how is that taxed?
Well, Social Security is taxed if you're a married couple. If you earn less than $32,000 or less per year, you pay no taxes on your Social Security. Now, that is earned income and any passive income that comes in. Earned income, of course, is money you work for. Passive income is retirement plans, required minimum distribution withdrawals from retirement plans, anything you get from a pension, and also it includes half of your Social Security. So if you draw $10,000 on Social Security, when you do your taxes, $5,000 of that is put on there as part of your income. If you earn 32 to 44, 50% of your Social Security is taxed. And if you earn over $44,000 as a married couple, 85% of your Social Security is taxed. Now, as a single filer, if you have $25,000 or less, nothing is taxed. If you have $34,000 to $25,000, 50% is taxed. And if you're over 34, 85% is taxed. So you just got to be real conscious of those and try to make sure that the amount of money maybe you're taking out of your retirement plans are within those parameters to keep your Social Security either to a very minimal tax or to no taxes whatsoever if possible.
Tim, I saw on your website, theplanadvisor.com, that you offer Medicare Advantage and supplement plans. I'm wondering, are there any issues surrounding those programs during the pandemic that we're living in now?
Well, not really. Mostly everyone just needs to know the details on how to make sure they have Part B all set up. Pretty much everyone will have Part A automatically, right? I mean, basically you have that once you get to where you're eligible. But Part B must be set up before they can even look at adding a Medicare Advantage or a supplement plan. So first of all, that's the biggest thing is people need to make sure they've got Part B all set up whenever you're going to lose coverage, that Part B is going to kick in. One quick story, and then I'll ask Bill his opinion on this. I've heard some people, not a whole lot, and really not so much in this area, but in other areas of the country, who remained on their job after the age of 65 and didn't take Part B as soon as they were eligible because they still had employer health insurance. And now they're having some challenges getting Part B started because now it's hard to get in touch with the Social Security office and things have changed during all this. So I have heard some stories about that, and we can help you if there's anyone listening that has that issue. We can help you, or just get with your agent, let them know there are ways around it. So there are things that can help if you are having some issues. Just get with your agent. Bill, do you have any thoughts on that?
Yeah, the biggest thing I think people probably need to be concerned with there is, and a lot of people in our area who are a little bit older, like my parents, for example, they're not particularly computer literate. So a lot of times me or my wife or my son or grandson has to do some of these things for them. So you have to rely on family and friends, maybe a church person, a person you go to church with or something, somebody you're close to, but you don't mind having your personal information. So you go online and you'll have to file for your Part B now. And that's the biggest thing you probably need to be concerned with right now, because it's hard to get in touch with the Social Security Administration to get signed up. And, of course, you can't go to an office because they're all closed down because of the pandemic.
We need to take a quick commercial break here in just a few minutes, but I want to talk some about long-term care, why someone would want that, and let's go a little bit into annuities, capital gain taxes. We are opening up the phone lines in case someone has a question. It's 1-800-469-0098. That's 1-800-469-0098. During this quick commercial break, Tim, if you don't mind, go ahead and give us your web address so people can look at what you all are doing and get a better understanding of this massive topic that we're talking about so that we can become clear and make the best choices that we can for us as individuals.
Absolutely. It's real simple. It's theplanadvisor.com. So just theplanadvisor.com. We've got a lot of questions you can answer right there on the website, or if not, you can contact us multiple ways right there from the site, and we'll get back to you as quickly as possible.
Thank you so much. We'll be back after this quick commercial break. This is your host, Christy Slaughter, on SuperTalk Saturday mornings, WFHG 92.9. Welcome back. This is your host, Christy Slaughter, on SuperTalk Saturday mornings, WFHG 92.9. I'm joined back with my special guest, Tim Wood. He is the broker and owner of the planadvisor.com, and I'm also joined with Bill Potter, a financial advisor. Thank you all so much for being with us this morning.
Thank you, Christy. Appreciate it.
Okay, let's talk about long-term care and why someone would desire having long-term care right now.
Okay. Well, first, just real quick, just another point, since we were just talking about Medicare a second ago. One thing that's important to consider about long-term care is that Medicare does not cover long-term care. So if you're on Medicaid through the state, then you're all good. But if you aren't and you've got over $100,000 in assets, then you need to look at a long-term care policy, because expenses, and here's just the basics about long-term care. If you've got over $100,000 in assets, expenses could reach $8,000 to $10,000 a month. And statistics show overall that about 75% of everybody is going to need long-term care at some point. And there's also some opportunities for long-term care, and that's why we have to look at each case individually. There's opportunities for long-term care that would come through life insurance or annuities that actually would work much better than a long-term care policy by itself. Bill, would you like to expound on that at all?
When you use life insurance and annuity products for long-term care, it's called equity-based planning. And what you do is it gives your money a multiplier effect. You may be paying a premium into a life policy of $10,000 a year, but that would give you $200,000 of death benefit. And you could be able to use that death benefit as a long-term care benefit for nursing home or home health care, which was critical care needs. That's the advantages a lot of times of using equity-based products. You get a lot more bang for your buck than just paying $10,000 a year premium for a long-term care policy.
Okay, gentlemen, I know that a lot of us are confused. There's so much information out there as far as Medicare is concerned, insurance options, things like that. And to make things even more confusing, now we have a lot of questions about the economy, some uncertainties. With things being really volatile right now, just talking among my circles, people are worried. They're not really sure what to do. They don't know if they should sell stocks, if they should buy, if they should invest. Is there a program where people's money won't go down if the market goes down, but can still go up with the market? Does that exist?
It does. Bill, you want to take this one?
Yeah. They're called equity index annuities, equity index life insurance products. Basically, how they work is they safeguard your principal that you deposit into them always. The only way that amount can decrease is if you take it out yourself. You can't lose because of market downturns or anything like that. It also gives you the ability of capturing most of the market upside gains when the market does start going back up. So it's very safe. It's extremely low risk. Volatility is low. All those things that you worry about when you get into the market, you don't have to worry about by using equity-based insurance products.
So what are some of the differences from life insurance and annuities, let's say a decade ago or 5 years ago, from looking back to the point that we are now? What are some of those differences?
There's a lot of... Go ahead, Bill. I'm sorry.
No, go ahead.
I was just going to say there's a lot of newer plans on the market that are better than the older ones. Not that the older ones were bad, but there's newer ones on the market, just kind of like cell phones, right? I mean, 10 years ago, we were all using flip phones and thought that was great. And now there's still some people that use them. They still work. Same with some of these older products. They still work, but there's a newer phone that can do, probably literally a million times more things. So it's kind of the same way. Bill, what do you think?
Well, the biggest thing, I've been in the business since 1993. Been almost 27 years, be 27 years next month. So I've been here for the development of these products from day one. Index products were starting to be really developed about 96, 97. They really took off into the early 2000s because they made changes in them. The early index products were products that only put more of the investment risk back on the client. Where the newer products, like I said, they've taken all that away where there's no volatility in them or a concern of loss to the client. But what has happened over the years, they keep changing, they keep innovating, making the products better, adding new investment options to them, new income options, and just various different things to improve them for client use and make them more client-friendly.
Gentlemen, you've talked about life insurance and annuities. If you could simplify, Bill, for us, what would determine whether someone would use life insurance or an annuity in a language that we can just really grasp and get our head around? What would those differences be, and why would you use those things? That's
a real good question. Probably the simplest way to look at it is you have to look at it, of course, on case-by-case basis, what the person wants and needs. Of course, and basically what they need. As an advisor, you try to steer them to, what they need more than sometimes what they want, because what they want sometimes can be based on bad information. But anyway, the simplest way to look at it is that if you have non-qualified money, money that has been taxed, a lot of times you look at life insurance programs instead of annuity programs, simply because they offer you more flexibility. They give you an increased death benefit, which can create an estate for your family. They give you the advantages of having more money than you've actually put into it for long-term care benefit, unlike an annuity does. So also, and they give you the ability to take money out income tax-free, do withdrawals there. So with the proper planning, you can create those situations in retirement to where your Social Security is going to never be taxed, and you always have more money available for you to spend instead of paying it to the state. So that's the biggest things you look at, kind of in a nutshell, simple. But But the big thing you got to remember, you got to look at it on a case-by-case basis and see what the person really wants and needs to be effective in their life for their future planning.
Tim, what if someone wanted to roll over their 401k or IRA over to you? Are there any taxes due on that?
Nope. No, there are no taxes due at all when you move capital from one plan to another of any kind. Now, depending on what kind of plan it was in before, there are some plans that, like Bill was talking about, that are using money that hasn't been taxed, like regular 401ks, and then those are taxed once distribution starts. So, no, when you're moving, if you were just going to move it from a 401k or from any, it doesn't matter what it is, put it into one of these, no, there is no tax on that. But that's one of the big things that we talk to our clients about is, you know, you need to kind of think, do you think the tax rates are going to stay where they are, which are historically low, or do you think they're going to have to rise just simply because of everything going on, especially now with, you know, everything going on and all the additional monies going into our national debt. So, you know, if you think that might happen, then you want to get into a product that is going to give you a tax-free option. So it depends on the situation. But no, when you're moving from one to another, there is no tax at all. Bill, you have any thoughts?
Yeah, that's just pretty much in a nutshell. You know, the only thing, when you have non-qualified money and start taking distributions out of it, folks need to understand that the only thing a part of that's going to be taxed is the growth. The principal will never be taxed again because you already paid taxes on that money as you accumulated it to put it into a vehicle, whether it be a life insurance product of any kind, whether it's annuity, life, or a mutual fund, a managed money account, or whatever. The growth becomes taxed, not the principal.
Tim, we have, of course, a lot of small businesses and larger businesses that are facing some financial difficulties and unexpected issues right now. There are business owners and property owners who are possibly looking at selling that asset and then taking in the cash. Is this the best thing for them to do, or what recommendations would you have for them?
Once again, it's kind of a hard, because it depends on the situation, right? Do I think it's a bad time to get out right now? Not necessarily, especially if they were already considering retirement. But once again, and Bill just touched on this, and I don't want us to keep harping on this, but the biggest thing is to make sure that you're in the right vehicle moving forward for what the tax rates are going to do and how that's going to work with, okay, do you want, are you looking just for a big death benefit, or are you wanting some kind of an income? Do you want a monthly income? And then you can get a monthly income, and then do you want to have to pay tax on that? There's a bunch of different things to look at. So it would just be a matter, I would strongly suggest anybody in that situation, whether they were selling a business or selling property or whatever, get with your advisor and make sure in these times and with everything going on and all the uncertainty, make sure you are in the absolute best position that you can be for whatever happens. So just sit down with your advisor, look at all the options, whether that's life insurance, whether it's an annuity, whether it's all these other things that we have available right now. Make sure you're in the right thing for yourself moving forward for whatever may happen.
If you'd like more information, you can visit theplanadvisor.com. I sold life and health insurance right out of college. So much has changed. I'm not currently an agent. But what about the insurance rates? Do we have any idea about how it's going to be, those are going to be affected with this pandemic? Are there any projections and things as far as that's concerned?
Well, life insurance companies have already started adjusting cost of life insurance up in policies. Recent data has shown that for the first time in our history, I guess, or in my lifetime, and I'm almost 62 years old that I know of, people are living not as long. And what life insurance companies are doing right now is they're breaking it down by income brackets. It seems the more well off you are, the longer you live. If you're more middle class or lower income socioeconomic levels, you have a lower life expectancy. So they're adjusting according to these things within products themselves. They are coming out with new cost of insurance tables. Most companies are. Some have already done it. Probably 2020 will be a a year that would have been a bigger year for readjustments, but since everything that's happened, these companies are closed down, so many people's working remotely, they don't have the advantages of being together and being able to do these things. That will probably be held off until next year, and the rates are changing. They will be, the life insurance will get a little bit more expensive. Not a whole lot, but a little bit.
Thank you all so much for being with us and providing this information today. If you'd like more information, you can contact theplanadvisor.com. Thanks for being with us, Tim and Bill. Tim, I've got to work with you with the Alzheimer's Walk for several years now. It's great to have you finally on this show talking about something that's extremely important for every single one of us to examine. Hope you all are doing well, and I'd love to have you back on anytime.
Absolutely. Thank you very much. Appreciate it.
Christy, thank you so much for having us, and y'all stay safe and have a good day.
Thank you so much. Again, if you'd like information, it's theplanadvisor.com.